Okay, interest rates. I know it sounds like something that only central bankers and economists would care about, and I get it, but here's the thing. The so-called boring stuff very often leads to the cleanest and most actionable fundamental opportunities. For instance, what if I told you that this trend could have easily been predicted just by knowing what was going on with the interest rates in the US and interest rates in Japan? Basically, by understanding interest rates differentials, you can ride some of the largest trends in the markets. And look, you might be a short-term trader. I get it. You don't really care about these type of time frames. But the truth is that this type of knowledge is not just for swing traders. I mean, knowing where the market is most likely going to trend to, think about that, is useful for everybody. Every type of trader. Why? Because if you trade short-term, you can still add confluence and conviction and filter also your short-term trades by lining up with the market direction. It's literally like trading with the trend because you know exactly what the trend is going to be based on the market context. But okay, enough said. Now, let me show you how you can use interest rates to know these type of trends when they happen. Now imagine the interest rates of country A rising and the interest rate of country B falling. That's what we call an interest rate divergence. One is moving up and the other is moving down. Now this is not a very common scenario because nowadays, central banks move together. They hike together, they cut together, they follow the same type of cycles, but still, interest rate divergence happens and there's always one or two divergences going on shaping large trends that run for months. So before I get into more details, I have to make sure that you have some basic knowledge of how interest rates influence the domestic currency. Now it won't take long, just a few important notions to know so that I'm sure you understand what we're going to talk about next. So first of all, interest rates hikes, so interest rates moving higher, are usually bullish for the domestic currency, while the opposite, so interest rates cuts, are usually bearish for the domestic currency. Now I say usually because there are more variables at play at this. It's not really only just rate hike bullish, rate cut bearish. There are many more variables like growth expectations, risk sentiment, stuff that I covered in other videos. And on top of that, when we look at, for instance, Euro USD, we're looking at the euro compared to the US dollar. We're not just looking at the euro itself, meaning we cannot just be looking at Europe's interest rates and decide where Euro USD is going to go because of that. No, because currency pairs are made of two currencies, so it's not just one or the other. For instance, think about this. The European Central Bank might be hiking, but what if the Fed is hiking twice as fast? Speed and size of the moves also matter. So looking at the interest rate of just one currency is not a complete picture. And that's where divergences are the cleanest and most obvious fundamental ones. Because on one side, there's a central bank hiking, and on the other side, there's one cutting. So one is acting bullish for the domestic currency by hiking, and one is acting bearish. Now, if this makes sense so far, perfect. Now let's get practical. Here you can see in the orange line the PBOC interest rate, which is basically China's central bank. And in blue, it's the Federal Reserve interest rate. In other words, we're looking at China's rates compared to the US. Now I know, you probably never thought about China's central bank, but turns out the Chinese yuan is actually a really interesting currency to trade. Now in this example, if interest rates in the US are rising and rates in China are instead falling, what should the dollar do compared to the Chinese yuan? It should gain in value. And that's exactly what it did. In other words, again, the PBOC, so China's central bank, was cutting rates, which is bearish for the domestic currency, while the Federal Reserve was instead hiking rates, which is bullish for the domestic currency. So what happened to USD compared to the Chinese yuan? It trended higher. Now that's the simplest way to think about interest rate divergences. If rates in currency A are going up, while rates in currency B are going down, then currency A appreciates against currency B. It's that straightforward. Now, being so straightforward, these obviously don't happen very often. So let me show you another slightly different example that broadens the type of opportunities that interest rates can actually create. Because this is an example where rates are not exactly moving in the opposite direction, but they're still moving away from each other, and that's still tradable. So here you can see the Bank of Japan interest rates in the orange line, which is there flat at the bottom, and in blue you can see the Federal Reserve interest rates, which is basically lifting off. Now, it's not really a divergence where interest rates are moving in the exact opposite direction, but still, one is moving away from the other. So this scenario still provides a solid trading opportunity. Here's USD JPY in that context. It trended nicely up. Why? Because interest rates differentials between the US and Japan were widening in favor of the US, so in favor of the dollar. Rates in the US were moving up while they were staying flat in Japan. Okay? Perfect. That's essentially the whole point. It's a simple, not too common, but extremely solid type of fundamental opportunity. Again, this type of divergences in interest rates create some of the best trends across currencies. They don't happen very often, but still, these allow you to ride big trends in which, you can take multiple positions. You don't just have to take one single trade for every policy divergence that happens. When you know things are trending, because of a policy divergence, you can use pullbacks to enter multiple positions along the trend. So the point is simply that when there's a monetary policy divergence, there's usually a trend to ride. You just need to keep an eye on what different central banks are doing. And when they diverge from each other, that's the signal to jump in. Now, is this all hindsight theory? Of course not. As always, everything mentioned here is practical stuff that we trade. Here's, for instance, a trade we took on a UD CAD, where there was a few hints of a small policy divergence building up between the two currencies. So between the Reserve Bank of Australia and the Bank of Canada. And, that turned out to be a pretty good trade. So in simple, the point is this, that when interest rates move, and also when interest rates expectations move, currencies trend. And when interest rates between the currencies move in the exact opposite direction, things really trend. So use that to your advantage in your trading.